or so, and it's been a little bit more to talk about in the last few weeks because we've had a little bit of a rally um, in the old crop futures contracts, which would be the March, which is getting ready to mature, and then the May and the July. That's the contracts that represent the value of cotton that was harvested from the 23 crop and is sitting in a warehouse and is probably already sold at this point. But just to keep things exciting, we had this rally. You can see the May contract peaked at 90, 95 or something like that, and it appears to have peaked last week, and it's down from there. Uh, the practical reason for the rally was what I'll call speculative buying, and particularly hedge fund buying. So if you look on the far right side of that slide right there, there's the uptick in price, and this green upward spike represents a ton of buying, like 60,000 contracts worth of buying by what I would call hedge fund longs. Hedge funds are investment companies that take clients' money, and they gather all the expert info they can. They have teams of people that study crops and study all the USDA reports and read all the online websites, and then they also have they have what you call it, machines that spit out, calculate buy signals and sell signals and all kinds of technical analysis stuff. Those are hedge fund managers, and they like to get on a bandwagon when they think the price is going up. They like to jump on the bandwagon and buy, and in so doing, they actually fulfill the prophecy and make the price go up. So they've done that. Now you can see from all these other green spikes of the past, sometimes they last a while, sometimes they don't. The previous one back in 2023, um, that's about 4, 5, 6 weeks right there. And this is about 2 weeks, but it looks like it's already shot its wad. So I, think the fun's over. Anyway, but the old crop got pulled up by that. And the new crop, that is the December 24 contract, the harvest time price for the crop that's going to be planted, it got pulled up for the ride too, which is good because for those of you in the high plains, these prices are being averaged together to give you your insurance price. So it's better for it to be higher, better to have a rally at this time of the year. So we'll see. That insurance price is going to be determined. All the averages will be done through this week, through the end of February, and it'll be on that basis. Um, Anyhow, let me just focus. I think the new crop thing is over. So the questions that people are asking now have to do with the fundamentals of the new crop market and how that might affect the December prices. And so at this time of the year, typically we get info and guesstimates and surveys on acreage and how much people are going to plant. So that's what the focus is. That's what the recent news has been. So let me summarize that for you. Um, First of all, the economics of how much is going to be planted is, as economists, we tend to think of relative prices of crops having a large influence on that question of how much people plant. And this is a historical slide showing acres of cotton planted over here on the vertical axis, and the horizontal axis is the ratio of corn futures, new crop corn futures to cotton futures in the first quarter of the year, the first 3 months. And all these blue dots are how much was historically planted, in 20 and in 21 and in 22. And there is a nice linear relationship. That is to say, when corn prices are higher, they plant less cotton. It's not surprising. And where corn and cotton prices are now, cotton's been going up, corn's been flat to lower. So it's been favoring cotton. The ratio's been shrinking. and it's been kind of moving us back up this trend line to planting higher and higher projected amounts of cotton. I would guess from where the price ratios are right now that we'd be planting 11.5 million or so, something, or even pushing 12 million. So we can look at surveys of farmers to see, maybe get confirmation of that. And so there's been a couple surveys that have been out in the last week or two. The first one was put out by USDA at their Outlook Forum a week or so ago, and they projected 11 million. So they were kind of looking at these relationships, I'll tell you, and they just assumed that this isn't based on a survey, but they assume that we're going to plant 11 million. And I'll tell you what the implications of doing that are in a second. But there was another report that came out just about 2 days after USDA's report, and it was the Cotton Council. They do a survey every year. They publish it. The market digests it, waits for it, anticipates for it. The Cotton Council report came out with a much lower number, under 10 million, and they released that a week ago Saturday. So you might wonder, well, under 10 is not 11. What's the difference? Why is the difference? And the difference is that the Cotton Council survey is conducted in mid-December to mid-January. So this is an earlier snapshot of intentions, back when cotton prices weren't as high and grain hadn't fallen as much. So I think this number is accurate, reflecting the intentions at the beginning of the year. But I think with the change in prices that we've seen in the first quarter, I think that's probably changed in cotton's favor. And I would go with the USDA number for the time being. Now we're going to get a couple more snapshots at the end of this month. They're putting out USDA is putting out what they call their prospective plantings. That's just another survey, and so we'll see if that's around 11 or higher or lower. And then at the end of June, there's another one. So the market's going to wait and digest these things as they come. But let's just assume for the time being we have 11. The other key thing is that we have more moisture than in recent years. And so usually in years like this, we have lower than average abandonment. That is to say, instead of only harvesting 85% of what we plant, I bet we harvest 87 or 90. That would be my guess, is that we have 10% abandonment. We end up harvesting 90% of what we plant. And if we do that and we have average yields, we're going to wind up with a 16 million bale crop, which I hope everybody has above average yields, and I hope we have a booming crop. But the supply and demand implications of growing a 16 million bale crop is that unless we see a big improvement in demand, we're going to have a whole lot left over. More supply and the same amount or uncertain demand means we're going to have more left over. That means carryover stocks are going to be higher. And typically when that happens, we have price pressure, not in the middle of the year, but at the end of the year. We may have price pressure, which could push futures from where they are now in the 80s, low 80s, mid 80s. It could push them down through the 70s by harvest time. Again, if we go from 3 million bales of carryover to 5 million. So that's something to watch. And it's basically something to pay attention to in terms of the timing. To illustrate the timing, I have this is what we call a seasonality. This is the average of December futures prices in the last 11 months of the contract. It's like 20 plus years worth of futures prices averaged together. And what's important here is not the price level, because there's 90-cent prices in here averaged with 50-cent prices in here. What's important is the seasonal pattern. And this is the typical seasonal pattern that we see, and it's not surprising, is that the higher prices are during the growing season when there's questions around what's been planted and questions about the crop condition and that sort of thing. And then there's a big downshift seasonally that usually happens after June and into July, when they get that last acreage report and they have a more informed picture of how big the crop is going to be and what the supply and demand implications are. I think we may wind up with something like this again, probably shifted up, whereas these prices would probably be represent a rally if we get rallies this year, it'll be into the 80s, through the 80s, up maybe pushing towards the upper 80s. But this downshift could put us back in the lower 70s or even lower, depending on how big of a crop is projected and what demand is doing. So the moral of this story is, the higher prices of the year that are going to cover more or all of your production costs, they're probably going to happen in the first half of the year. And that it behooves people to think about doing at least a little bit of forward hedging or forward cash contracting, where they can. And that would sum it up. So I'm going to leave you with my contact information in my slideshow and stop sharing. Hopefully I can stop sharing.
Thank you, John. Appreciate. Hey, any questions for John?
Stop sharing.
Yuri, do you want to put your slides?
Yes, sir, but can you allow me to share?
I hope you can now. I've stopped.
Everybody should be allowed to share.
Here we go, sir. 1 minute. Here we are, right?
Great. Thank you, Yuri.
Great. Let's go. I'm going to talk about grain market outlook. Here we have a schematic representation of the U.S. grain. My argument today will be here in the bottom line that price is a function of ending stocks relative to use, and particularly for corn, we see the ending stocks is swelling and growing as pressuring prices down. So I will try to show some numbers that gonna reinforce this argument that stocks are growing and pressuring prices down. So here we can see on the left side, we have production. Production is the product of yield and area. There's a battle for area between corn and soybeans, and we have like outstanding yields in corn recently. So also drought affect the overall production, and also this price competition between soybean and corns. On the right-hand side, we see that there is still a lot of factors going on. Is still the Russia Ukraine war, is still problems in the Middle East that may kind of escalate for a major war or not. We have the shipping crisis, for example, the Suez Canal, and also we have China with pork production that it's not so outstanding. We see a lot of complaining that the industry has not been profitable, with kind of decrease the demand for grains. So the bottom line is that prices should go down because we are kind of increasing our stocks. The next one. Here we go. Well, talking about prices, here we have like Texas cash prices. We see the green line sorghum with a discount to corn in the black line and wheat in the red line. So, and the blue line shows when Russia invaded Ukraine, the prices were trending up, but recently they moved sideways until the middle of 2023, and now the prices are trending down. As we talked before, ending stocks explain a lot of the price movements. Oops. No, they're not. Just I'm trying to move my. Here we go. The prices are trending down, particularly because the days of use on hand are increasing. So this chart shows the days of use on hand for US in blue, the blue bars, and we have roadless China in yellow and the road in the brown lines. As we can see, we have the days of use on hand increasing since 2020. Since 2020, we see the days of use increasing, pressuring prices down. So we talk a little bit about the prices. Now I'm gonna talk a little bit about the area. This table over here shows that since 2019-20, we have more 85 million acres allocated for grains. This is about the same size of a US soybean area. So what does it mean? It means that the producers are responded for the increase in commodity prices and starting planting and planting more. So we have more acres, we expect more production. As a result, we expect pressure for the prices to goes down as well. That's in world view. Another thing that may affect the production, that certainly affect the production, is the weather. Right now, we are in the El Nino range, but we are trending towards the summer for the La Nina range over here. What does it mean? Well, we can see over here that El Nino, for example, from December to February, brings cool and wet temperatures here in South Texas, but also brings warm and dry seasons here in China and some Southeast countries. Also in Brazil, we have like a bad crop this year. Because of that, we have dry and warm affecting Brazilian crops. However, we see Argentina and Uruguay crops benefiting for the El Nino climate. However, when we look in the graph down here, we see that towards June and August, when we may see the La Nina, will not affect that much the US, but will bring better conditions for Brazil and China and Southeast Asia. So we talk about this battle for acres. Here we have in the y-axis the excess acres for corn. So we divide the soybean prices by corn. When we move towards the right in the X down here, we see that when the relationship is bigger, we have less excess of acres of corn. So before we had like over 10 million acres in excess for corns. Now we expect something around 4 million acres more for corn. So we see a decrease in area for corn. So we talk about area, talk about weather. Now let's see the yield. That's a beautiful graph of the technology advancing in corn production. We see the yields trending up and up and up. Looks like the sky is the limit. We expect another record in yield. So to summarize all of that, we can see here the supply and demand chart from the USDA. If we look at the middle column over here, the first number that I would like to highlight is the yield. We had a record yield with 177 bushels. That's amazing. But we may note as well that we increased the planted and the harvest area. As a result, we had a record production in 23-24 production over here. Well, we don't see the same increase in domestic use. As a result, we have another ending stocks with over 2 billion bushels. So we increased our days on hand from 36 to 54, and average prices went down from 6.5 to 4.8. When we look forward for the next crop season in the third column, we may foresee another record yield, but we will see that corn may lose some 4 million acres for soybeans. As a result, because we had like last year a major or a big end of stock, given our production with a record yield, we may have a record supply. However, we will have as well a record domestic use, but will not be in the same pace that the supply. Bottom line is that we're gonna increase our ending stocks, increase our the number of days use on hand, ration prices down. So, wait a minute. Well, that's why it's so relevant for us to see the days of use on hand. Here we have the days of use on hand and prices, seasonally adjust prices. You guys can see that when we increase the days of use on hand, 40, 50, 60, with the prices go down, down, down. And we are in this range over here that the prices may rover around 4 something and $5. So here another way to see that's here we model the prices over the years, and we foresee the prices over.
Yuri, we cannot see your slides.
You cannot?
No.
Wait. You can see my screen?
We see you.
Ooh, that's terrible. Better see these slides.
There we go. Good.
I don't know. Let me try again. Here we go. Right?
There it is. Thank you.
So yeah, the relationship is there. As the days of use in hand increase, the prices goes down. And here we have the modeling of the prices for October, and we may see the prices hovering around 455. So that's what we expect from prices given the current situations of supply and demand. Well, we have this expectation, but there's a lot of major factors going on. We have high interest rate, slow growth. People talk about soft land. We have high input prices. Volatility is not high right now, but nobody knows what's going to happen for all this turmoil around the world. So discussion of trade, we have elections, and over 3 billion people going to vote this year. So we have a lot of disruption that may happen along the year, and also weather is always uncertain. Well, towards the end of my talk, I'm going to show up that we have the budgets, and also, although the things may seem difficult, as likely change in costs or yield or prices may change the figures. So we provide some tools for the producers to calculate the cost-benefit analysis, and just visit the extension website that we can help with that. So then I finish my talk, Pancho.
Excellent, Yuri. Thank you very much. Any questions for Yuri? David, do you want to start uploading your slides? I like how you're planning to start, David.
Heck yeah. I'll tell you what, I get to talk about good stuff. Pancho, you see the screen okay?
The screen looks perfect. Yes, thank you.
Yeah, I thought I'd run with a title like this. If anybody's been to the auction market lately, and maybe last week, or seen some of the sales last week, it seems like prices skyrocketing higher. I thought, well, shoot, to infinity and beyond. But I'm always reminded. I had an economics professor back when I was an undergraduate, and also in my master's program. He was a macroeconomist. I thought he was one of the finest teachers I ever had in college. He is anyway. He used to talk about, trees don't grow to the sky; they don't go up forever. And so anyway, I always, I like this. I like Mo Buzz Lightyear quote, particularly thinking about cattle prices. But I keep in mind they don't go up forever. But these are certainly times that are pretty good with rising prices, record prices. If some of our auction market prices last week were record high, and that time something good happened, I think. So that's a good thing. Now, certainly we are benefiting some from the grim news on the grain side, but cheaper feed corresponds to higher calf prices and higher feeder prices, and so that's part of this increase. So I just used sort of a pretty simple chart of 500 to 600 pound number one steered calves, Southern Plains. Heck, prices going up. Gosh, we're roughly $80 a hundredweight higher than we were a year ago. Certainly higher prices for folks who bought some stockers back in the fall for wheat or oats, who probably it's right on the edge. We took that decline in prices late, kind of in September, October. They may or may not have already bought those stockers. If they'd already bought them, I think that probably led to a lot of heartburn. Yet we've got rising prices that I think is going to turn out pretty well for folks who bought those stockers. And if they bought them lower, it's even a little more gravy. So whether we're talking about 5 to 6s or 7 to 8, certainly higher prices, and probably certainly recapture some of those worries. Recapture some positive after those worries of the fall, but certainly higher prices, lower feed, The demand for those calves, demand for those stockers has continued to be pretty good. Even though we've certainly seen some negative closeouts on some fed cattle, particularly back in January before this increase in prices. But if we're looking at the fed cattle market, we got higher prices there too, certainly higher than we were a year ago. Last week, I didn't quite have all the data for the average for the week, but I penciled in about 181 for Southern Plains price. I think we sold some on Friday at 182. Certainly certainly better prices than a year ago. And that's, I think that's certainly positive news as well. I thought I'd jump to the cutout a little bit to talk about the wholesale market. I think you'll see some stuff this week in some of the trade papers, worries about beef demand. Beef demand was the really pleasant surprise last year. People continued to buy beef even in the face of record high retail prices. Retail prices hit a record in about July. They slid a little bit lower through the year. But if we look at the wholesale market, some of the worries there are that, given the fed cattle market continuing to go up, record high retail prices, why aren't we seeing more strength in the wholesale cutout market? We're sitting there at about $3 last week, a little better than the year before at this time. But I think there's a couple of things at work. One is, at least until the last week or two, we actually produced as much or more beef in January, early February as we did the year before. So there was plenty of supplies. So that's part of it. I think another part is that, we're supposed to hit 85 here today, I think. But even with this warm weather for us, it is still winter by the calendar. It's not unusual to see some lower prices in February and March before we hit this springtime higher prices. As we really start moving into spring, moving into grilling season, and seeing that demand. So if we dug a little deeper from the cutout and looked at the primal cuts, the cuts that are ahead of a year ago are our end cuts, chucks and rounds, the end meats, the short plate. So some of the end stuff, it's the steaks that are sitting about where we were a year ago. So if we look at the rib or the loin, look at ribeyes, New York strips, as we dig in deeper, they're about where we were a year ago, and the strength has been in the end meats, which is what we often see in the wintertime. So, what are we seeing in terms of demand? I think that's really just the big uncertainty that's still out there. So this is something I think we'll see more written about, more talked about. I'm not sure it means a whole lot yet. Let's see where we go as we get into spring, get into grilling season, to see where we go from there. But certainly, the strength in the primals are about what we would expect this time of the year going on. One of the other things I'm going to pull out one of these cuts. This is wholesale boneless beef, 90% lean. So really, this is lean beef that's going to ground beef. So we hit 305 last week. This thing has been skyrocketing higher. What is this giving us? This is really our thinking about ground beef or hamburgers, right? So you see where the cull cow market is. A lot of that cull cow beef, lean beef, gonna go to grinders, gonna be ground beef. This is what's going on in the ground beef market as we face tighter supplies of cows, tighter supplies of cow beef. Yet the demand for ground beef is still there. And so really some sharply higher prices there. I think this is pretty interesting and pretty instructive for why we see the cull cow market continuing to go up. With tighter cow numbers, there's just fewer available. It's driving those prices up and also supporting this market as well. So I think we have both some demand support and certainly some supply support for these kinds of higher prices. So I thought that one was pretty interesting and worth kind of pointing out. Since we met last time, we had two big cattle reports. One is the cattle inventory report. So it came out on the 31st of January, so almost a month old. But I thought I'd show a couple of charts here, and that way, if you want these charts, you got them. I'm happy to send them to you. Total cattle inventory was down almost 2% for January 1. That's the fewest number of total cattle in the U.S. since 1951. Pretty easy to see. I just went back to the mid 60s in my chart here, but you can see our cattle cycle, our cyclical numbers going down, where each low is lower than the bottom of the trough of the cycle before. What I don't have on here is production, and I think you'll know that really the innovation, the efficiency in terms of beef production really goes the other way. It has a cyclical pattern, but it goes the other way, that we're producing more beef per cow, yet our cow numbers are smaller. This one catches the headlines, so I think that's worth using. Kind of shows you where we are. I like to use cow inventory because really that's sort of the productive engine of the industry. Is it all starts with the cows. We were down about 2.5%. That's the fewest number of beef cows in the U.S. since 1961. So certainly fewer cows. Why? Tech driven by drought, driven by economics, with low calf prices over the last several years relative to costs. And so from both an economic standpoint and an environment standpoint, we've got fewer cows. But if we look at the Texas numbers in this, we got 4.1 million beef cows in the state. That was down from the year before. But, if I compare to the previous trough, which is really after our big drought, nationwide, we've got fewer cows than we did in 2014. But if we look at Texas, we got about 200,000 more cows now than we did in 2014. So, relatively speaking, the rest of the country has taken a bigger hit on cow numbers than we have. And so we have a few more head than we did following our drought. So I think that's kind of interesting to dig into there. And I think it just shows we may be in a little better position than we were back then. If we look at the number of heifers held for replacements, again, very low, lowest in the data, down another 1.4%. So if we think about speed to rebuild, we've got fewer heifers held back as replacements. And so, if rebuilding is going to start, it's, in earnest, it's really got to start out of this year's calves, not last year's calves. Now, if I look at the Texas data, we actually had about 10,000 more replacements in Texas compared to the year before. There's some states in the northern plains like Nebraska, places like that, that had a few more replacements held back also compared to the year before. So certainly the thoughts there, if you had the grass, to try to at least be thinking about expanding and maybe able to do a little bit of something. And that's certainly what we see in the state level data. But overall, boy, not a lot of heifers held back for replacement, which means that, again, if we're going to start rebuilding, it comes out of this year's heifers, which is only going to drive those calf prices even higher because we're going to pull those supplies out of the market, those supplies of calves, those supplies of feeder cattle, driving calf prices and feeder cattle prices even higher. So much like we saw with record prices in 14 and 15 when expansion really started, we're not quite there yet in terms of expansion starting, but that's still yet to come. And I think the promise of much higher calf prices than we've seen so far. Excuse me. Cattle on feed report came out Friday afternoon. This is where I get to brag a little bit as one of the market analysts that does pre-report estimates. I actually hit USDA's placement numbers exactly at the number that came out in the report. So I was pretty happy about that. Sometimes, even a blind hog finds an acorn. But look at placements down from a year ago, certainly lower. Again, remember late last year, we really saw a boost in placements, those September, October numbers, pulling animals ahead, placing more heifers. Really a short-term phenomenon, and we certainly see lower placements now. I think we're going to continue to see reduced placements, fewer cattle on feed. We take those placement numbers and the number of cattle on feed, we're still just barely above a year ago, less than 1% above a year ago. I would expect over the next couple of months to really see the number of cattle on feed decline below a year ago. And we'll start seeing even tighter slaughter numbers, tighter beef production. You know, we're going to see what prices can do. And so, you know, on the demand comment, both John and Yuri had comments about demand. From a beef standpoint, I think where we're headed is we're going to test consumers' willpower. We're going to test their wallets in terms of prices and see what consumers are going to pay. I do think there's some room for some lower retail beef prices. Because if we look at those margins, what we've done is we've really squeezed packer margins to them being now in the red. Yet with high retail prices, we continue to see a pretty large, what we call wholesale to retail or grocery store margin. And so, you know, I think that's something interesting we're going to see even with tighter supplies. We're going to see how high that retail price can go. Certainly as you know, with higher prices, people buy less. Just basic economics. When price goes up, people buy less. What we're really interested, though, in is do we see some shifts in demand, whether it's income, whether it's cheaper other meat protein items? That's the part we're going to find out as we go forward. So certainly tighter supplies and higher prices are on the horizon, especially in the calf market. So heck, that report came out Friday, so a quick little recap of that. And let me show one more chart, just something on lamb and mutton. Certainly the lamb market, for those of you who are interested, I like to have a chart each time on this market. What I would really highlight is take a look at production. We're really seeing production ramp up seasonally. You'll notice on whether it's our 5-year average on that red line or the dotted line, we really hit a seasonal peak in lamb production at our Easter market. And that's what we're headed into, given that we're already in Lent. We've got production popping up higher. Even in the inventory report, it showed a few more lightweight market lambs compared to a year ago, even though the ewe flock was down a little bit from the year before. It was down about what I expected. You know, I think it was down about 2%. That was about what we saw. I think all of us that follow this market sort of figured. But a few more market lambs, that's boosting our domestic production headed into the Easter season. I think this increase in production is also probably pressured prices a little bit, particularly if we look at the kind of the traditional slaughter weight, heavier lambs. We've seen some lower prices there over the last couple of weeks. I think really related to this boost in production. So heck, that's my last slide. Let's see if I can end the show and stop sharing.
David,
Maybe.
thank you very much for the good news.
Yeah. Hey, I'm glad to follow.